Hey traders, Raghee here, and in this free video we're going to recap the API to EIA response as well as the trade that we made today in the chat room around crude oil. So a couple things. First of all, for now, and a lot of members have told me that they do not have access to the June contract, and we've been talking about the July contract, and that's what we traded today. Some traders have even said they need to go out into August. So check with your broker when you're trading crude to find out which contract you have access to. Most brokers and most members have reported back to me they do have access to July or the end contract. So that's the example we're using here. But again, just make sure you move further out into the year. Do not trade June. July is fine. August is fine. Even September. But let me show you another view of something just so y'all know what the trickiness in terms of the different contract months might be. First of all, they're all trading at different prices. But I'm going to slide over an image of the tool that I use on TradeStation. And here it is. Okay, so what you're looking at right here is the futures chain for crude oil. So here's M, June, N, July, Q, August, U, September. Now look at the volume and look at the open interest. That's pretty much what you want to follow. Open interest is where I want to be if I'm trading overnight. In other words, I'm in a position trade where I might be in for days, if not weeks. And of course, being cognizant of when the first notice date is. In other words, a lot of the chaos in May was right up against the 48 hours into delivery. So we don't want to be owning any of these contracts. Really, for me, I want to be thinking about scaling out of the front month 2 weeks before first notice date. All right. Now, since I'm trading mostly July, it's not as big a deal, but keep that in mind. The chaos across all the contracts could increase, the volatility, right, as we get close to the first notice day for the front month. And as you can see, that is going to be, again, if you're looking at the M contract, you'll see here, May 2-1, May 1-9, right there in the red. And we're looking at July, where we have until June 2-4 and June 2-2. Again, 2 weeks before first notice date is my guideline. But take a look at the open interest. Then we have decent open interest in July. In fact, not only is it decent, it's better than June. Traders are doing exactly what we're talking about here. They're moving further out. And then next would be August. That's decent. That's decent. But you can see the sort of front month may technically be June, but in terms of where volume and open interest are, that is clearly out in July. All right, so there's that. So we were trading July. Feel free to trade August, but if you can trade July, that'd be great. So what did we do? Well, we know the API expectation set the scene for the, here, I'm going to show you the notes here. They set the scene for the EIA. So yesterday's API expectations was for 8.44 million barrels. We got 8.125, which was smaller. And if you're watching crude oil yesterday at 4:30 Eastern, Tuesday at 4:30 Eastern, you would have noticed crude headed higher. Why? 8 million barrel build is a lot, but not when you were expecting 8.4. All right, so then the 8.1 becomes sort of the expectation that the EIA number will be reacting to. Right, so a larger build than 8.125 could be bearish. Smaller than that is going to be bullish. So what we did is we set up an order in front of 10:30 Eastern to sell July crude at 25.93, which was the upper end of the current intraday range, and also a 0 on my V-score indicator. And so we said, hey, EIA can and has triggered equities volatility. Certainly, it's going to trigger crude oil volatility, and we're looking for that spike to take advantage of. All right, so those are the notes and the alert that went out. And then that's exactly what we shorted. That was the event. We shorted into that. And then that was pretty much how we played that. And we had a couple downside targets on the way. And so what I'm trying to say is if you have a major event, you can wait for the event to create that price response. And if there's a level or an indicator that you can use to show that there is an exhaustive level to the up or down side, you can fade it. And so what we did is we faded the crude oil inventory's response, not getting in front of the number, not guessing which way the spike is going to go. I don't do that. We look to fade the response. Okay, so that's a little insight into what I like to do when it sets up on that Tuesday to Wednesday API to EIA setup. Hope that was helpful. I'll see you in the next update.